Chapter 2, Financial Statements. This chapter I would like you to do on your own. It's actually, in a way, a prerequisite for this class. So you should already be very familiar with what's on these slides. And what you will find on the slides is a review of what we mean by a balance sheet, what we mean by an income statement, as well as cash inflow versus cash outflow. So let's start with the big picture of financial statements. Firms regularly prepare financial statements. They need to report them to the public, and these are the documents that illustrates firms' profits, expenses, any type of loans they may have, value of all assets that they work with, and so on. Let's start with something else. Individuals, you and me, right? There are a lot of financial questions that we sort of have to face in our everyday life. For example, what is my house worth now? How much do I still owe in credit card bills or student loans, home loan, car loan, and so on? How much did I earn this month? How much did I spend this month? And how much did I save this month out of my paycheck, right? Now, firms actually ask themselves the same exact questions. What are firms' assets worth now? And assets may include things like buildings, machinery, equipment, as well as things that cannot be touched, like software patents that also may have value. Then how much does a firm owe to its creditors, maybe bank loans or investors who bought its bonds, as well as suppliers? How much did the firm earn this month? How much did the firm spend this month? How much profit did the firm make this month? So the same kind of questions, right? Now, let me ask you this. What do the first two items in this list of 5 items have in common, both for individuals and firms? What they have in common is they are asking about, regardless of when things were purchased or when a loan was taken, as of today, how much those two are worth. So it's like a snapshot of an individual's financial situation or a firm's financial situation. Or we are looking at, you can also say that we are looking at a firm at a point of time. So as of today, let's say January 1st, 2019, everything that the firm owns, regardless of when that was bought by the firm, how much is that all worth? And how much do we still need to pay back for the loans that we took, regardless of when we took them? Now, the last 3 bullet points have a slightly different time period embedded in them. They are what we refer to as over a period of time. So all my questions have this month, right, in them. How much did we earn this month or in the most recent month? Or maybe it's not during a month, but during a quarter or during a year, kind of the most standard time interval in this class. How much did we spend this month or this quarter or this year, and how much profit was made? So if we consider all these financial questions and put them into these 2 different groups, then that's how we get these financial statements. A balance sheet shows a snapshot of a firm's financial situation. So that's what we can also refer to as at a point of time. So let's say as of January 1st, 2019, how much does our firm own and how much does it owe? On the other hand, an income statement shows, for example, over the period of 1 year, what has changed. How much did the firm make? How much did it spend? and the difference between how much was made and how much was spent, or the profit that was made. Let's review the structure of a balance sheet. On the left we put assets, on the right we put liabilities and equity. Assets is how much all a firm's assets are worth in dollar amount. Liabilities, how much we owe, how much debt we have, and equity is the same thing as net worth. So think about a firm, let's say, shutting down. If it sells everything that's under its assets, makes money, right? And then if it uses the money to pay back everything that it owes, then how much would be left? That's the net worth. The balance sheet identity is this little formula that says what's on the left side, assets, equals everything that's on the right side, liabilities plus equity. Now let's look in more detail at what's under assets, what's under liabilities, and what's under equity. Assets are first. We can categorize assets into current assets and fixed assets. Current assets include items like cash, inventory, and accounts receivable. And fixed assets include everything else. It includes, kind of think of much bigger assets. Tangible, that could be touched, like buildings, computers, equipment, trucks, and so on. And intangible, things that have value but cannot be like touched with your hands, right? Like patents, like software. Another way to think of what makes certain assets current assets and others fixed assets is think about how long it may take to convert them into cash, to sell them, in other words. So current assets are cash and things that could be converted into cash within 1 year, so a relatively short amount of time. For fixed assets, the amount of time it would take to convert those assets into cash would be significantly longer. For example, it typically takes many months, it could be many years, or at least a few years to sell a building. So this is sort of a convention in finance. Short-term versus long-term. Short-term, we assume it's anything that can be turned into cash within a year. In this sample balance sheet here, we actually have, in a way, two balance sheets. One for 2011 and one for 2012. So current assets and fixed assets are on the left-hand side, and notice how current assets are first, followed by fixed assets on the bottom, underneath. And it's actually going to be the same structure when we then look at liabilities and equity. We will have current liabilities first and then sort of longer-term liabilities underneath. Now let's actually talk about liabilities, and on the following slides we will look at equity. Liability is the same thing as debt, how much we borrowed that we still need to pay back. So the money that we owe to our creditors. And just like with assets, liabilities can be called current and long-term. Current is what we basically need to pay off within a year. So it's the same sort of time period that we used for current assets on the earlier slides. And under current liabilities we have accounts payable. So that's what we owe to suppliers from whom we purchased our supplies on credit. So we already have the supplies in our hands, but we have not paid the cash yet. There is a time delay. And so for that time period, the amount that we owe will be put under accounts payable. Notes payable is basically short-term loans. And long-term liabilities include long-term debt. By the way, this is where bonds belong. If a company sells bonds as a way to borrow money, they would appear under long-term liabilities. And in this sample balance sheet, current liabilities appear first on the right-hand side, and then they are followed by long-term debt underneath. In finance, we use the term leverage or financial leverage a lot. This should be interpreted as using debt or having debt, having money that's borrowed that needs to be paid back. And so a firm is called levered if it has debt in its capital structure, regardless of how much. It can be a lot of money that's borrowed or a little bit of money that's borrowed. All such firms would be called levered. But a firm with more debt would be called a firm using a higher financial leverage. An unlevered firm is that firm that has no debt at all in its capital structure. Then this little picture here shows kind of something from physics, where you push on this longer end of the surface just a little bit, and it pushes up the other shorter end by a lot. So that's actually where the term leverage is coming from. It's coming from physics, and this is actually beyond the scope of this class, just to explain. But turns out that a firm can borrow just a little bit to see a huge increase in profits. So this is where the word leverage is coming from, but all you need to know from this slide is the word leverage refers to using debt. That's it. And finally, let's review the part of a balance sheet called equity, bottom right. Same thing as net worth. So equity has different terms. You can also say shareholders' equity or stockholders' equity or common equity or owner's equity. It's all one and the same thing. Now there are two components. One is typically called common stock and paid-in surplus. So that's the dollar value of all shares when they were first sold. So let's say 1,000 shares are sold for $100 each. Then this part in the balance sheet is going to have $100,000 in it. The second component of equity is called retained earnings. So this is basically additional money that's added with each year. That's nothing but how much profit from the annual production and sales is kept or retained by the firm. So profits could be distributed as dividends to the stockholders, or maybe some are distributed and some are retained, or maybe all of profits are retained. So the amount that is retained every year is added to the firm's equity into the balance sheet. And again, our sample balance sheet shows the two components of equity in bottom right of this balance sheet. What is net working capital? Net working capital is the difference between current assets, cash, inventory, accounts receivable, and current liabilities, short-term loans and accounts payable. So let's say the number we get is above zero, which means current assets are larger than current liabilities. That's a good thing, because it means we owe this much as current liabilities to all the people we owe money to within the next 12 months, and we do have enough cash to do that. We have enough cash plus things that could be quickly converted into cash. like inventory, which could be sold, or accounts receivable that could be sped up, maybe at some discount. But it may not be a good thing when current assets exceed current liabilities by too much, because that implies that we're not using our cash or cash-like items very wisely. What would be a wise way to use our cash? To invest it so it works for us and generates interest. So if we have way too much cash sitting in our hands, then yeah, it's enough to cover current liabilities, but it's not being used in the wisest way. Let's look at this example. Let's say we need to calculate the net working capital in 2011. How would you solve it? Well, by definition, net working capital equals current assets. So what are current assets? The total current assets in 2011. That's $1,112, right? And we need to subtract the current liabilities for the same year, which is $428 for the year 2011. So current assets minus current liabilities gives $684. There's something called book value of assets or liabilities or equity, and there's something known as market value of assets or liabilities or equity. What's the difference? Where do we see book values? In the balance sheet. Everything in any balance sheet is the book value of all assets, liabilities, and equity. This is also known as historical costs, which means it's not necessarily the value of assets, liabilities, and equity in today's market. In other words, when you look at equity in a balance sheet, you see some dollar amount. But that doesn't mean that that's how much all shares of stock are currently worth today. This is just their historical cost based on the price per share when the shares were sold originally in the primary market. So maybe originally each share sold for $80 and the firm has 10,000 shares. Then what you would see in the firm's balance sheet for the year of the shares issue, the year after, 2 years after, and today, you would see $800,000, kind of the same number. It will only change if the firm decides to either sell additional shares, then this number would go up, or maybe if it decides to buy back some of its shares, then this total amount will go down. But otherwise, if none of those are happening, then the balance sheet would keep showing $800,000 year after year after year. However, the market value of shares of stock may be changing dramatically over time if shares go up in price. So market value is kind of the true value today, how much you can sell a share for or some asset for, right? Remember, it's not all about equity in my example. It could also be for assets or liabilities. For example, what's the book value of a building that was purchased 5 years ago? It's whatever remaining, whatever value is remaining, and accountants will tell you exactly what the remaining book value is for a building purchased 5 years ago, right? Buildings, deteriorate. They lose their, they lose their original sort of quality, income producing ability. So the book value goes down over time. But maybe the market value of a building has gone up since the building was purchased. And that's because we are currently maybe experiencing a real estate boom, right? So the market value and the book value do not need to match. They can be very different and have different trends. And so in this little example, I'm again looking at equity, shares of stock. So let's say historically shares were sold for $80 each. But now you can sell each share for $95. This means that if the firm has a total of 10,000 shares, then the total market value of the firm's equity will equal $950,000. So see how it's a much larger number than the book value of only $800,000. In this table, I show a balance sheet with current and fixed assets as well as liabilities and equity. And the second column on each side is the market values of each item. So when you look at book values, that's what you see in a balance sheet. And if you also compare with the market values that are probably known for a lot of items, that combination of book values and market values can give you a much larger insight into what's going on with this company. So for example, you can look at equity, right? And see that the book value is 600, but the market value is 1100. So it's almost double, right? What could have caused such dramatic difference between the book value of stock shares and their market value? 600 reflects the historical value of all shares when they were sold for the first time. The market value is how much they're worth today, right? So since these shares of stock were originally issued, the company has improved significantly in the financial point of view. So it has become a lot more profitable, right? Now let's review an income statement, the second financial statement that firms are required to report, typically every quarter or maybe every year. And it shows a company's performance over a period of time, kind of in very general terms. So usually over one quarter or over 1 year. So maybe between January 1st, 2018 and January 1st, 2019. An income statement shows a firm's income over a particular quarter or a year. Income is nothing but profit. So how do we find profit? All revenues minus all expenses, right? And so an income statement summarizes revenues, how much money was spent, and what the resulting profit or income was for that particular year. This is an example of, a rather simplified income statement. It always starts with revenues, also known as net sales. Sometimes this is called sales revenue or net sales revenue. And then everything that follows is with the minus sign. So that's all expenses. So when we take this sales revenue and subtract the cost of goods sold, which includes things like paying money to suppliers, utility bills to produce our product that we are selling, paying wages to employees, and so on. When we subtract that, and then when we also subtract depreciation of the assets that were used for production, we get EBIT, which stands for earnings before interest and taxes. Then we further subtract interest on loans, and that gives us our taxable income. Taxable income is what we need to pay taxes on. So not sales revenue, but only taxable income, a much smaller amount. Let's say the tax rate is 34%. Then we take 0.34 multiplied by our taxable income. Let's say it's 624 millions. And that gives us 212 millions of dollars. And when we subtract the tax amount, we get net income. So net income is technically the last item in an income statement. And the reason there are two more items, dividends and addition to retained earnings, is because this is what the firm would then be doing with its net income or profit. So it can use all of it to pay out dividends. Or, like in this example, it actually doesn't distribute all of its profit among stockholders in the form of dividends. So only part of the net income is paid out as dividends, and the rest is retained. So this amount, the retained earnings, is then added to the balance sheet under equity on bottom right. So to summarize, in an income statement, the first item, the first row is the revenue. Everything else is expenses. And when we subtract expenses from the revenue, we get the profit for the year, also known as net income. Just a little detail about income statements. So let's say a firm sells $500,000 worth of product in some year. But let's say a lot of this was sold to customers who used their credit cards. What this means is that maybe by the end of the year, only part of this amount of money was collected in cash, and the rest will be paid shortly when the next year begins. So how much do we need to put in an income statement under revenues? The full $500,000 worth of product that was sold, or only the amount of cash that has already been received? So the answer is the full amount. And so it's good to keep in mind that little detail, that this does not necessarily reflect the true amount of cash that was collected during that year. Income statements contain a so-called non-cash item. Where is it? Which one is it? Is it cost of goods sold? Is it interest paid? Actually, it's depreciation. What's so special about it? Why is it called non-cash? Because depreciation, so here it's $65 million, does not necessarily reflect how much was spent. It needs to be in an income statement for tax purposes in order to correctly calculate how much taxes the firm will owe to the government. So what exactly is depreciation? Let's quickly review that. Firms are allowed to expense a purchased fixed asset, let's say a building or some piece of equipment, gradually over time. This spreads the cost of the asset over its serviceable life. So let's say a firm paid $650 million to buy some expensive piece of equipment. And accountants check, okay, for this type of asset, it's gonna be losing its value over 10 years. After 10 years, it's worthless. So its useful life or economic life is 10 years. And what accountants would then do is they would take the full value, $650 million, divide by 10 years, and get 65 million years. And they would call it annual depreciation. How much value is lost every year. So maybe this is exactly where $65 million came from in this sample income statement, right? And so $65 million, the annual depreciation, will be used in the income statement during the first year since the equipment purchase, during the second year, during the third year, fourth year, all the way to the year 10 since the equipment was purchased. And that will, if you did not have depreciation, this item, right, then our taxable income would be higher and we would be paying more in taxes. So it's a good thing for firms to have this depreciation deduction that's allowed for tax purposes, because it allows them to save money in taxes. In this example, we are asked to calculate the net income. We are given sales $687,000. Costs, $492,000. Interest expense, $26,000. And depreciation, $42,000. The corporate income tax rate is 35%. What is the net income for Corner Bakery, the name of this company? To solve it, we should essentially build the full income statement. We start with the sales revenue, $687,000. Then we subtract the costs, which are also called costs of goods sold, COGS. So we subtract 492,000. Then we subtract depreciation, which is $42,000, also given to us, and that gives us earnings before interest and taxes, EBIT, $153,000. Then we subtract the interest. That's interest paid on loans, right? Long-term debt, like bonds. That's $26,000 in this problem. After subtracting interest payments, we get the income that we will be required to pay taxes on, taxable income, $127,000. If the tax rate is 35%, then 35% multiplied by $127,000 would give us the tax amount that we are required to pay in the amount of $44,450. And so after paying that to the government, we would be left with net income of $82,550. And this net income is the profit, which we are free to distribute between the stockholders, or maybe use only part of it as dividend payments, and we would retain the remainder. Lastly, cash flows from assets. So what is a cash flow? You probably have heard me use the word cash flow so many times in this class, right? It's basically amount of money. That's all I really mean by it. But this term is used by people in finance all the time. The reason we say cash flow is because it's kind of very vague. It doesn't really tell anything about whether we mean money spent or received. So actually we can make it a little bit clearer if we say cash inflow or cash outflow. So cash inflow is some amount of money that is received, typically in some year. So cash inflow in year one means over the first year of some, project or whatever that is, we received the total of this much. Cash outflow is the money that was spent in some year. Why is it important? So what else is important? What important detail is embedded in the term cash flow? What's important is when we call something a cash flow, we mean that money is actually received or spent. Remember, we had depreciation in our income statement that we called a non-cash item. So we cannot call it a cash flow. Depreciation is not a cash flow. It looks like a cash outflow, but we do not actually spend it. We only need to use it as if it's a cash expenditure, so that we can calculate our taxes correctly. That's the only purpose. Then if you go back to a balance sheet, we can say the following. All assets that we are working with, buildings, equipment, and so on, they're all being used in order to bring cash flows, cash inflows, right? So these are cash flows from assets. And then what do we do with all the money that the assets generated for us? We spend it. We pay some of it to our creditors. So liabilities is like cash flows to creditors over the years. And then the rest goes as payments to stockholders, such as dividends. So cash flows from assets equal cash flows to creditors plus cash flows to stockholders. So this is something that you would be able to see for some given amount of time. So let's say within a year, within the most recent year, this is how much money our assets brought to us, how much money we made, like a profit, right? And then within that same year, we spent some of it on paying back to creditors and the rest to pay money back to our stockholders. And creditors and stockholders are two sort of groups of investors that have interest in our firm. So they have like stakes in our firm. They provided money to us so that we can give them the money back with the some return on top. So cash flow from assets are cash inflows. Cash flows to stockholders and creditors are cash outflows. And this little formula is known as cash flow identity. The cash flow from assets are also called free cash flow because the firm is free to distribute it between creditors and stockholders, the investors that have stakes in the company. And chapter 2 kind of flows well with chapter 10 when chapter 10 is covered right after chapter 2. And so what you will see in chapter 10 is how exactly do we calculate cash flow from assets for some particular year. And remember, this is basically nothing but profit. So how do we calculate profit for this year and the year after that and another year after that? That's all in chapter 10. Let's do sort of a comprehensive example. In this table, we are given different items. If you look closely, you will realize that some of them come from an income statement, others from a balance sheet. And we also have the value for each for 2010 and 2011. Question 1. Which items belong to a balance sheet and which items belong to an income statement? Sales, that's an income statement. Cost of goods sold, that's an income statement. So is the interest, depreciation, and taxes on the very bottom. So the first four and the last taxes are part of an income statement. Everything in between is from a balance sheet, and that includes cash, accounts receivables, current liabilities, inventory, long-term debt, net fixed assets, and common stock. Question number 2. What is the net working capital in 2011? What is the definition of net working capital? It's current assets minus current liabilities. Do we have current assets here in one line? No. But we know that current assets include three things: cash, accounts receivable, and inventory. So we can add these three up. And then we need to subtract current liabilities. And we already have the value for that. If we didn't, then we would need to add up two items: notes payable and accounts payable. But we already have the sum of the two. So for the year 2011, we add cash, accounts receivable, and inventory because that's our current assets. So 313, 1,162, and 1,521, and we subtract the current liabilities, which is 1,051. And the difference gives us the net working capital equal to $1,945. The fact that it's positive tells us that we have enough cash or things that could be quickly and easily converted into cash during the year 2011 in order to meet our short-term obligations, such as paying back short-term loans or money to suppliers. And the last question, question number 3. What tax rate was used to compute taxes in 2011? Well, we know what the tax amount was paid, right? What tax amount was paid in 2011? That's $670. So what was the taxable income? The taxable income is always calculated by taking the sales revenue, subtracting the cost of goods sold, depreciation, and interest. When we find the four numbers and put them together like this, we get the taxable income of $1,912. So out of $1,912, $670 were paid in taxes. So what percentage of taxable income are taxes? To find the tax rate, we take the tax amount and divide it by the taxable income. 670 divided by 1,912 gives a 35% tax rate. Summary. We looked at two financial statements. We reviewed balance sheets, which show a firm snapshot or a firm at a point of time, how much it has in assets regardless of when they were purchased, how much it has in debts regardless of when they were taken. And we reviewed income statements. That's when we sort of zoom in at a specific time period, maybe a quarter, maybe a year. So it's a firm's performance over a period of time. And then lastly, we reviewed what we mean by cash flow from assets, also known as free cash flow. So the word cash flow indicates money actually either spent or received. And so there is a special item that came up in this chapter known as depreciation, right? Called depreciation. And depreciation is known as a non-cash item because it's only there in an income statement for tax purposes. It doesn't necessarily reflect how much money was spent. So cash flow from assets that assets generate in some year are then split between the two groups of investors that provided the funding to the firm by buying its by lending the money to the firm and buying the firm's stocks. That's creditors and stockholders. So cash flow from assets equals cash flow to creditors plus cash flow to stockholders. And in chapter 10, we will look at cash flow from assets in more depth.